Hey everyone, welcome back. Today we're going to be looking at something I think you're going to find really interesting.
Oh, yeah.
It's about getting more out of your investments.
Hmm.
Yeah, so we're diving into this White Coat Investor article, and they lay out 9 ways you can potentially boost your returns.
9. That's a lot to unpack.
It is, and it's not just about, picking the next hot stock or anything. It's more
No.
about making smart choices that could really add up over time.
I like that.
Yeah, and some of the stuff in here really surprised me.
Oh, yeah. Like what?
Well, did you know that sometimes getting rid of risk can actually lead to higher returns?
Really? That sounds counterintuitive.
Yeah, it is. And another thing that was interesting is how they talk about, good old-fashioned hard work.
Oh, you mean like sweat equity?
Exactly.
Yeah.
They actually consider that to be an investment strategy.
Huh. That's interesting.
Yeah, so there's a lot of unconventional wisdom in here.
I'm intrigued. So where do we start with these 9 ways?
Well, the article kicks off by talking about the math behind building wealth.
Oh, yeah, the fundamentals.
Right, they break it down into like a simple equation with 4 variables.
Okay, I'm listening.
So it's like what you have now, your starting point,
Hmm.
then how much you save each year.
Right. Saving consistently.
Exactly. Then how long you keep saving for.
Makes sense. Time is a huge factor.
Totally. And then, of course, how well your investments perform.
So that's the investment return piece.
Yep, those are the 4 pieces of the puzzle.
Gotcha. So we've got our starting point, savings rate, time, and investment return. But doesn't the article say we can only really control 2 of them?
Yeah, that's what's so interesting, right?
Not
Like,
true.
we can't control what we have right now or how long we live.
Makes sense.
But the things we can control are our savings rate.
How much we put away each month or year.
Exactly. And our investment return, how well our investments do.
And those 2 levers can make a huge difference, right?
Absolutely. And the article has this amazing example to illustrate it.
I love a good example. Lay it on me.
Okay, so imagine you're saving $50,000 a year for 30 years.
Okay, that's a good chunk of change.
Right. So if you're getting a 5% return, you end up with $3.5 million.
Not too shabby.
Right. But here's the kicker. If you bump that return up to just 7%,
Just 2% more.
yep, suddenly you're looking at over $5 million.
Oh, wow, that's a huge jump.
I know, right? It's the power of compounding in action.
It really highlights how important it is to focus on those 2 things we can actually control.
Exactly. So we got to make our savings work as hard as possible.
Absolutely. But the article is also upfront about the trade-offs.
Oh, right. Like there's no free lunch.
Exactly. If you're looking for higher returns, you're usually going to have to take on more risk.
So how do we find that balance then? Like, how do we know how much risk is right for us?
That's where things get a little personal, I think.
Okay, how so?
Well, you really have to understand your own risk tolerance.
You mean like, how much can my portfolio bounce around without me freaking out?
Exactly.
Yeah.
Because honestly, the worst thing that can happen to an investor isn't a market crash.
What? Really?
Yeah, it's more about panicking and selling low because you can't handle the ups and downs.
So I could actually lose more money by being too scared and selling at the wrong time.
That's the risk. You lock in those losses and miss out on the potential recovery.
Oh, wow. Okay, so it's not just about picking the right investments. It's about understanding myself, too.
Absolutely. Self-awareness is key.
So much to think about. All right. Well, enough about risk for now.
Okay, I'm ready for some action.
Me too. Let's get to those strategies for boosting returns.
Yeah, let's dive into those 9 tips.
All right, so where do we start?
Well, the first one might surprise you. It's all about eliminating what the author calls uncompensated risk.
Uncompensated risk. What's that?
It's basically risk that you're not being rewarded for.
Mm-hmm.
You might think diversifying is just about playing it safe.
Yeah, spread your bets and all that.
Right. But it's more than that. Eliminating unnecessary risk can actually boost your returns over time.
Really? How so?
Like cutting out the fat,
Mm-hmm.
making your portfolio leaner and more efficient.
Oh, I see. So it's not just about avoiding losses. It's about maximizing gains, too.
Exactly. And the article points to a couple of common culprits when it comes to uncompensated risk.
Okay, I'm all ears.
First up, we've got actively managed funds.
Those are the ones with the fancy fund managers, right?
Yep, and they often come with higher fees.
Which eat into your returns.
Exactly. And the problem is they don't necessarily perform any better than just tracking the market with a low-cost index fund.
So I could be paying more for the same or even worse performance.
That's the risk.
Yikes. Okay, what's the other culprit?
Overly concentrated individual stock holdings.
Oh, so like putting all your eggs in one basket.
Exactly. It's tempting to try and pick winners,
Oh, yeah, for sure.
but if that one investment tanks, you could be in trouble.
Makes sense. So diversifying helps smooth out those bumps in the road?
Exactly. It's about spreading that risk around.
So we're not just spreading our bets for safety's sake, we're actually setting ourselves up for better returns in the long run.
That's the idea. You're getting rid of risk that's not doing you any favors.
I never thought of it that way. That's a good point.
It's about being strategic with your risk. And that brings us to another important point, taxes.
Oh yeah, everyone loves saving on taxes.
For sure. But it's more than just saving money today.
Okay, go on.
It's about giving your returns a turbo boost over the long term.
I'm listening.
Minimizing your tax burden can make a huge difference in how much your investments grow over time.
Okay, so how do we actually do that?
Well, the article talks about maximizing contributions to tax-advantaged accounts.
Oh, you mean like 401k, Roth IRAs, HSAs, all that good stuff.
Exactly. Those accounts are like a secret weapon.
Because the money grows tax-free.
Exactly.
Yeah.
It's like a shield protecting your investments from the tax man.
So that tax shelter can really add up over time.
Oh, yeah. We're not talking about a few bucks here and there. We're talking about potentially thousands, even hundreds of thousands of dollars in extra growth.
Wow, that's significant.
Right. So it's not just about the accounts themselves. It's also about understanding the tax implications of your investment choices.
Oh, so like some investments are more tax efficient than others.
Exactly. You got to factor that into your overall strategy.
Okay, so we've covered eliminating unnecessary risk and being smart about taxes.
So far, so good.
Now, what about the cost of getting advice? Some people swear by hiring a financial advisor while others go it alone. What's the best approach?
Well, that's a tricky one
How so?
because I don't think there's a one-size-fits-all answer.
Okay, fair enough.
A good advisor can be incredibly valuable.
Especially if you're new to investing or have a complicated financial situation.
Exactly. They can help you create a plan, choose investments, and stay on track.
It's like having a personal trainer for your money.
I like that analogy, but just like with a personal trainer, there's a cost involved.
Right, advisor fees can eat into your returns.
So you have to weigh that cost against the potential benefits.
It's a trade-off for sure.
The article actually suggests exploring some lower cost options.
Oh yeah, like what?
Well, you could try negotiating a lower fee with your current advisor.
Never thought of that.
Or you could even consider learning to manage your own portfolio.
The DIY route, huh?
Exactly. There are tons of resources available online and in libraries to help you educate yourself.
But that takes time and effort, right?
It does. It's a commitment, for sure. But it could save you a lot of money in the long run.
Okay, so for someone who's maybe feeling overwhelmed or unsure of where to start, an advisor could be a good investment.
Definitely.
But if you're confident in your ability to learn and manage your own money, the DIY route could save you a lot of money.
Exactly. It all depends on your individual circumstances and preferences.
All right, that makes sense. Now, speaking of commitments, let's talk about asset allocation.
Ah, yes. The classic stock versus bond debate.
Well, specifically, the article talks about the ratio of stocks to bonds in your portfolio.
Right. That's asset allocation in a nutshell.
So how do we decide what the right mix is?
It's a balancing act between risk and reward.
Okay, I'm following you.
Stocks have the potential for higher growth, but they also come with more volatility.
It's like a roller coaster ride, right? You can reach those thrilling heights, but you got to be prepared for some drops along the way.
I love that analogy. And then you have bonds, which are more like a gentle stroll in the park.
They're more stable, but they might not grow as much.
That's right. So your age and time horizon play a big role here.
Oh, right, because if I'm younger and have more time to recover from losses, I can handle a higher stock allocation.
Exactly. You've got time to ride out those dips and hopefully benefit from the higher long-term growth potential of stocks.
But as I get closer to retirement, I might want to shift towards a more conservative portfolio with more bonds to protect my nest egg.
Exactly. You don't want to be taking unnecessary risks when you're about to start withdrawing from your savings.
So it's not just a set it and forget it decision. It's about adjusting your strategy as you move through different life stages.
Exactly. Your needs and risk tolerance will change over time.
Makes sense. And it seems the article takes that a step further.
Oh, yeah? How so?
It suggests that we even consider the risk level of the stocks and bonds we choose.
Right. So it's not just about stocks versus bonds. It's about digging deeper and understanding the different levels of risk within those categories.
Okay, this is getting interesting.
It all comes down to the concept of risk premium.
Risk premium. Okay, what's that?
Imagine a seesaw.
Gotcha.
On one side, you have a well-established company like Apple.
Okay, a blue chip stock.
Right. They're pretty stable, but their growth potential might be limited.
Low risk, but also potentially lower reward.
Exactly. On the other side of the seesaw, you have a small startup company.
Ooh, Much riskier.
right? They could either take off and make you a fortune.
Or completely crash and burn.
Exactly. But because of that, higher risk investors expect a higher potential return from the startup.
It's like they're getting paid extra for taking on that extra risks.
That's the risk premium in a nutshell.
So it's not just about the type of investment, it's about the level of risk within that type.
Absolutely. And this applies to entire asset classes, too.
Oh, really? Like what?
Well, emerging market stocks, for example, are generally considered riskier than U.S. stocks.
But they also offer the potential for higher returns.
Exactly. Higher risk,
Yeah.
higher potential reward.
Okay, so we've got stocks, bonds, and then the article throws in another curveball, alternative asset classes.
Ah, yes, going beyond the traditional investments.
So what are we talking about here?
Things like real estate, private equity commodities, maybe even fine art or collectibles.
Wow, that's a wide range.
It is. The idea is to further diversify your portfolio.
So if the stock market tanks, my other investments might hold steady or even go up.
That's the hope. It's like building a safety net within your portfolio.
I like that. But the article also cautions that these alternative investments often require more research and due diligence.
Oh yeah, for sure they can be less liquid.
Meaning harder to sell quickly.
Exactly. And they often come with higher fees or require a larger minimum investment.
So it's not for the faint of heart.
Definitely not a beginner move.
All right, well, speaking of putting in the work, the article also highlights the power of sweat equity.
Ah, yes. Good old-fashioned hard work.
Exactly. This isn't your typical passive investing.
Right, it's about actively building or managing something to create value.
So like real estate investing.
Perfect example. Landlords put in work maintaining properties, finding tenants, dealing with repairs.
And that all contributes to their returns.
Exactly. Or think about starting a business.
Now that's a lot of sweat equity.
It is. It's high risk, high reward.
But the potential returns can be much greater than just passively investing in the market.
Absolutely. You're in control. You're building something from the ground up.
So it's about leveraging your skills and knowledge to create wealth, not just relying on market growth.
Right. It's like investing in yourself.
I like that. Okay, last but not least, we have leverage.
Ah, yes. The double-edged sword.
The article makes it sound a bit risky.
It can be if you're not careful.
So what exactly is leverage?
Basically, it's borrowing money to invest.
Okay, and how does that boost returns?
Well, it amplifies your gains,
Yeah.
but it also amplifies your losses.
Oh, so it's a high-risk, high-reward game.
Exactly. You're essentially using a megaphone to boost your returns.
But that megaphone can also make your losses louder.
Precisely. So you have to be very careful with leverage.
The article mentions real estate as a classic example.
Yeah, mortgages are a form of leverage.
And even student loans.
In a way, yes, anytime you're using borrowed money to invest, you're using leverage.
Okay, so it's important to understand how it works and the risks involved.
Absolutely. You don't want to get in over your head.
All right, so we've covered all 9 strategies from the article: eliminating uncompensated risk, minimizing taxes, reducing the cost of advice, adjusting your stock-to-bond ratio, choosing riskier assets within those categories, exploring alternative investments, adding sweat equity, and carefully considering leverage.
Wow, that's a mouthful.
I know, right? It's a lot to digest. But the article doesn't stop there.
What do you mean?
Well, it also highlights some controversy and nuance surrounding these strategies.
Oh, so like different viewpoints and debates.
Exactly. And the comment section of the article is a goldmine of insights.
Sounds like we need to dive into that.
Let's do it. Let's see what sparks debate among the readers and uncover some of the nuances within these approaches.
I'm ready when you are.
Oh,
Let's go. All right. So one of the big debates that pops up in the comments, is about how much of investing success comes down to picking the right investments.
right, like finding that magic formula.
Exactly. Versus managing your own behavior.
Ah, the psychology of investing.
Yeah. Is it more about having the perfect portfolio or about keeping your cool when the market goes crazy?
That's a good question. So what do the commenters think?
Well, the author of the article seems to think that asset allocation is the key driver of returns.
So like having the right mix of stocks, bonds, and all that.
Exactly. But a lot of commenters push back on that.
Really? Why is that?
They say it's more about controlling your emotions and not making stupid decisions.
So like even if I have the perfect portfolio, I could still mess things up by panicking and selling at the wrong time.
That's exactly what they're saying.
Oh man, so it's not just about the numbers, it's about my own psychology too.
All right? You got to be able to stick to your plan even when things get rough.
Easier said than done.
I know, right? But there's actually some research that backs this up.
Oh, really?
Yeah, there's this company called Delbar, and they've done these studies that show the average investor actually does way worse than the overall market.
What? Really? Why?
Because they let their emotions get in the way. They buy high and sell low. Basically doing the opposite of what they should be doing.
So it's like having a Ferrari but not knowing how to drive it.
Exactly. You're not going to win any races that way.
Makes sense. So we got to be aware of our own biases and how they can affect our decisions.
Absolutely. One commenter even quoted this finance guy, William Bernstein.
Oh yeah, I've heard of him.
He said, and I quote, "The biggest enemy of the investor is the investor in the mirror."
Wow, that's powerful stuff.
Yes, right? It's a good reminder that we need to be our own financial therapist sometimes.
Totally. So what else were people talking about in the comments?
Well, another topic that got people fired up was peer-to-peer lending.
Oh yeah, P2P lending. That's where you lend money directly to other people, right?
Exactly. You're basically cutting out the banks.
And that can lead to higher returns, I've heard.
Well, the author of the article actually said he's invested in P2P loans himself.
Oh, wow. So he's putting his money where his mouth is.
Exactly. And he said he's seen returns of like 8% to 12%, even after accounting for some loans going bad.
That's not bad. But what did the commenters say?
Well, some of them were a little skeptical. They brought up the lack of regulation and transparency in this space.
So it's a bit of a Wild West out there.
Yeah, you could potentially get those higher returns, but you also need to be really careful about which platforms you're using and what kind of loans you're investing in.
Definitely not for beginners.
I would agree with that. And then finally, the comments section touched upon a pretty controversial topic.
Ooh, I'm intrigued. Lay it on me.
Leveraged ETFs.
Those are the ones that are designed to amplify the daily returns of an index, right?
Exactly. Like if the index goes up 1%, the ETF goes up 2% or 3%.
I've heard they can be really risky.
They can be. The author actually warns against them.
Why is that?
He says that chasing daily returns can lead to taking on way too much risk without actually getting the results you want.
So it's like a gamble.
In a way, yeah. Remember that seesaw we were talking about?
Like the blue chip stock and the startup.
Exactly. Well-leveraged ETFs are like putting a giant weight on one side of that seesaw.
So if things go your way, you get a huge boost.
But if they don't, you could come crashing down hard.
Ouch. Okay, so proceed with caution.
Definitely. The author suggests that if you really want to use leverage, traditional methods like mortgages, student loans, or margin accounts are a better way to go.
Because they're more transparent.
Exactly. You know what you're getting into.
All right, so we've covered the 9 strategies from the article, and we've even delved into some of the controversies and nuances that came up in the comments.
That was a lot of information.
I know, right? It's
Yeah.
a lot to process.
Yeah.
But I think it's been super helpful.
Me too.
Yeah.
I always learn a lot from reading the comment section.
Me too. You get those different perspectives and real-world experiences.
Exactly. So what do you think is the most important thing for our listeners to take away from all of this?
That's a good question. I think the key takeaway is that there's no one-size-fits-all answer when it comes to investing.
Right? What works for me might not work for you.
Exactly. The best approach depends on your individual goals, how much risk you're comfortable with, and how long you plan to invest.
It's like finding a suit.
A suit. Okay, I'm listening.
Yeah, you need one that fits your body and your style.
Oh, I see. So it's not about copying what someone else is doing. It's about finding what works for you.
Exactly. And beyond the numbers, it's also about understanding yourself,
Around psychology.
right? Your emotions, how you react to different situations. Because ultimately, the biggest risk in investing might be the one we create ourselves.
By making impulsive decisions.
Yeah, exactly. We got to keep our emotions in check.
So self-awareness is key. We need to know our strengths, our weaknesses, and how we'll react when things get stressful.
Absolutely. And of course, we need to keep learning and educating ourselves.
Knowledge is power, right?
Absolutely. This deep dive has given you a lot to think about, but it's just the beginning.
The journey continues.
Exactly. The next step is to take this knowledge, do your own research, and start building an investment strategy that aligns with your individual goals and risk tolerance.
It's like we've given you a map, but you get to choose the destination and the route you want to take.
I like that analogy. It's exciting.
It is. So what really stuck out to you from all this information? Was there anything that surprised you or made you think differently about investing?
You know what I think is really cool?
What's that?
It's how the article balances these like opposite ideas.
Opposite ideas.
Yeah, like on the one hand, it's all about taking risks, exploring different asset classes, maybe even using leverage to boost your returns.
Be bold.
Exactly.
Right.
But then on the other hand, it also stresses the importance of being cautious.
Right. Knowing your limits.
Exactly. And prioritizing long-term stability over like chasing quick wins.
So it's like walking a tightrope.
That's a great way to put it. You got to be bold, but you also got to be careful not to fall off.
It's that sweet spot between playing it safe and pushing yourself outside your comfort zone.
Exactly. And that's why I think this deep dive has been so helpful.
Oh, so?
It's given us the knowledge and the tools to make informed decisions, you know.
Right. It's like, we've got the map, now we just got to choose our destination.
Exactly. Now it's up to you to take this information, do some more research, and create an investment strategy that feels right for you.
I love that we've given you the building blocks. Now it's time to design and build something amazing.
This is an exciting journey.
It really is. And as a final thought, I want to leave you with this. Think beyond just the numbers.
Beyond the numbers.
Yeah, think about how your investment choices reflect your values, you know.
Your values.
Yeah, like your dreams for the future, the impact you want to have on the world.
That's interesting. So it's not just about making money. It's about aligning your money with your purpose.
Exactly. It's about using your money to create a future that you believe in.
So as we embark on this investment journey, we got to ask ourselves, what kind of future do we want to build?
And how can our investments help us get there?
Those are great questions to ponder.
They are. On that note, we'll wrap up this deep dive. Keep learning, keep exploring, and keep investing in yourself and your future.